5 costly investment mistakes that you're probably making right now, at least 4 of them, and the simple fixes you need in order to get past that. So mistake number 1 is not actually investing in the stock market, right? I mean, that's the basics. You have to be in it to win it. That's how the saying goes. The reason why most people never invest in the stock market is maybe it's like the genetic code that we've been programmed with, right? I was born in India, right? Indian family. They wanted me to be a doctor or a lawyer or an engineer or something along those lines. And trading is something that they looked at as like gambling. So originally, my dad gave me like $5,000, right? Something around that price point. He's like, okay, this is going to be a great lesson for you, right? Go invest this. You're going to lose all of it. He's going to learn his lesson the hard way. But I made that $5,000 go pretty far at this point, right? So mistake number 1 is a lot of people don't invest, right? Maybe it's their financial code, or maybe they think it's gambling, it's speculation. They don't trust the banks. They don't trust Wall Street. But that will be the biggest mistake you will ever make. So let's take a look at this chart. All right, I'm going to bring up this chart in front of you. So this is the chart of the stock market, the S&P 500. And as you can see, it has gone straight up forever, right? Now, look at that little where it says wake up. That's the 2008 financial crisis. That's where a lot of people said, you know what, the stock market's a scam. We're never going to invest in the markets ever again. Nobody trusts Wall Street. You might remember back in the day, there used to be movements like Occupy Wall Street. Anybody remember that? And people vowed never to invest in the stock market again. Right? The average person said, we're never going to do it. And now the average person is broke. I mean, take a look at the market. It's gone straight up, right? Forever. So that is why you need to be investing in the markets for the long haul, right? Now, mistake number 2 is lack of diversification. So what I mean when I say lack of diversification, right? What diversification really means is you don't want to put all your eggs in one basket. Because what happens if that basket goes away? You're done. So you never want to invest all your money in like one stock or one thing. So now diversification means you should have different stocks in different sectors. Now, a lot of people come to me and say, you know, Anmol, I'm diversified. I have a lot of different stocks. I'm like, okay, what do you hold in your account? They have some Apple, they have some Microsoft stock, they have some Google, right? They have Amazon, and they're like, look, I am diversified. But that's not really diversification, because all you really have is technology stocks. So what happens if the technology sector goes down, right? Then all of them are going to go down. Now, all of them are also going to go up if everything goes up, but you don't want to be reliant on one sector. So true diversification, what that really means is you having maybe some energy stocks, right? Like ExxonMobil, Chevron, right? These companies. Then you have some technology stocks like Apple, you have some Microsoft, right? Maybe you have some real estate stocks. So you have this diversification. So if one part of the economy goes down, you're not going to lose all your money, right? Something's going to go up, something's going to go down, but you're relatively going to be maintaining that money. So does that make sense, everybody? Lack of diversification, like how you want to be diversified in different sectors, yeah? Awesome. So that's the diversification, what I mean by that. So you need to be properly diversified. You want to have these different stocks, different sectors working for you, and you never want to be concentrated on one thing. I'm going to put all my money in Bitcoin, or I'm going to put all my money in this. You don't want to do that, because now you're taking risk with your future, with your financial future. You don't want to risk it. So we're not trying to get rich quick here. We're trying to get rich for sure, right? Over the long haul, right? I've seen people come and go in this industry. I've been doing this for about 15 years now. I've seen people come and go. It's like a revolving door. People come into the markets, they learn the lesson the hard way, and it just keeps repeating itself. The people that have stuck around follow these principles to a T, okay? So let's dive into mistake number 3, picking stocks, right? You don't want to be picking individual stocks, but Anmol, you just said have a diversified portfolio, have all these different stocks. Now you're saying don't pick stocks. We're going to dive into that in more detail, but the key is most people do the wrong thing when picking stocks. Because here's the fact. All of us in here could own Apple stock. All of us could own Tesla stock. But our returns, how our accounts do, is going to be vastly different based on what? Based on where we bought them. What if you bought Tesla in 2020, 2021? Well, you're technically still down. But what if you bought Tesla last year or earlier this year? Now you're up. So we could all be in the exact same stock, but our returns are going to be vastly different based on where we actually bought them. Does that make sense? So you don't want to be picking stocks. Most average people are going to pick it the wrong way. Because what do we people do? When the stock is going up, it's in the news, everybody's talking about it, we want to buy those stocks then. So in the Wall Street, we call it feed the ducks. When the ducks are quacking, you feed the ducks. So when everybody's in the news, everybody wants to buy GameStop, right? We're all selling it to them. And that's why you saw the stock's down 80, 90%. So you don't want to be holding on. So that's why don't pick stocks if you're new. Now, if you're experienced, you know how to read charts, you know how to read technical analysis, maybe you've gone through one of my programs, then yes, we could get into that level, but that's a little bit more advanced. And as I said, today I want to give you something that's going to be applying across the board to everybody here. So next, I want to cover the design of the market, the S&P 500 and the NASDAQ. How is the market designed, right? Now, the stock market is designed in a way to always go up over the long haul. Now, not in a smooth line, not in a straight up line. It's going to have its ebbs and flows, just like a heartbeat, right? If you look at it in an EKG monitor, it's going to have its ebbs and flows. Nothing goes up in a straight line. And the market, however, is designed to always go up, always, every single time. So what does that tell us? We need to be invested, right? And we need to not worry about the short-term downturns. One of the reasons most people never invest is, but Anmol, the election's coming up, right? When the election's over, they're like, but now the new policies are going to ruin the market. I don't want to invest. Then they're going to be like the economy, recession, inflation, all these reasons I don't want to invest. But they forget that that downturn is going to be short-lived and we're going to resume our uptrend back up. And most people make the wrong decisions. They start selling on the way down and then they start buying on the way up. Completely opposite, okay? So here's another chart. Again, this is the same chart of the S&P 500. Now I want you to notice, see how the chart has always consistently gone up? But you see how it's not just gone up in a straight line, it has its pullbacks along the way, right? And some of that pullback you see in the middle of the chart, that's the 2020 crash. Now, when it was happening, everybody was thinking it's the end of the world. Market's gonna crash, everybody gotta work from home, all these companies are gonna shut down. But that's just a little blip on the chart, and we're much, much higher than even the COVID crash. We've recovered all of that. We've gone through Ukraine, Palestine, Israel, all these things going on in the world. So it's designed in a way to always go up. Why is it designed like that? Because the S&P 500 or the NASDAQ, it's not the same exact stocks that were in there 10, 15 years ago. What they do is every few years, the S&P 500, they look, what are the companies that are not performing well? What are the companies that are not doing well? And guess what they do? They remove them from the S&P 500. And they're like, which company is doing better? They add them. So they're doing all the work for you. They remove all the bad companies. They keep adding all the good companies. So naturally, it's always going to go up, right? So that's one of the things, the design of the market that I want to emphasize. Because if the S&P 500 had the exact same stocks that were in there, let's say 10, 20 years ago, guess what would have happened? The market would have already crashed a long time ago. But they remove all the bad ones, add all the good ones, so it's always going to naturally go up. And it's also the part of the American culture, right? 401ks, IRAs, we want to keep investing every month. So if everybody keeps putting in money every single month, or in the IRAs or 401ks, guess what's going to happen? Slowly, we're going to keep going up. So that's why I want to implore you to hey, you got to be invested in the market long haul. Don't worry about the short-term gyrations. Don't worry what's going to happen in the economy. We've gone through the Greece crisis, the debt crisis, all these things, but guess what? The market's always been higher, right? And if you never invested, we think that the money is just sitting in our bank account and it's safe. It's not safe, right? If inflation's at 6%, even if you're earning 4% on your account, you're still losing 2% every single year, right? That's why we want to be investors, so that our money is working for us. Because one of the things, that I realized, at least in my life, is we can keep trading, we can keep having our businesses, we can keep making money, but what if something happens to me and I can't do that anymore? What if I can't work anymore? At least now I have some money working for me, right? Rather than me having to always work for my money, right? So hopefully that makes sense to you. Now, here's a compound interest calculator. Again, you can find this easily on Google. Just type in compound interest investment calculator. And in those calculator, if you plug in the numbers that you can actually physically invest in and do, you're going to see where you're going to be at the end of 20 years, 30 years, 40 years. And now when we have that formula, what does that enable us to do? We can tweak it. So on this chart, you see here, if I put in $1,000, just $1,000 in the stock market, and I put in like $50 a month, I'm sure everybody in here can do $50 a month, right? I mean, I'm being super realistic here. I mean, if I take a look at your bank accounts, there's like Netflix, there's all these things, charges going on. That's way more than $50. But if you put in $50 a month and $1,000 account in 40 years, that would have given you $242,000. Now, some of you guys might be thinking, but that's not enough for 40 years, only $240,000. Okay, here's another example. Now, in this example, we're playing with the same numbers, $1,000, right? And now we're doing it for 25 years. And now you can see we're going to end up at the same level. Same figures here. You can take a look at it on your screen. $1,000 in the market. If you put in maybe 500, the more you put in every single month and the more you start with, the faster the compounding happens, right? Take a look. Now, if you put $1,000 and now you can do $500 a month, now you're crossing, 2 million, $500,000 in 25, 30, 40 years. So again, as I said, We're not trying to get rich for quick. We're trying to get rich for sure. Now, if you're in your 20s, 30s, 40s, 50s, imagine where you would be 20 years from now. Imagine where you'd be 40 years from now. That's the mindset I need you to have. So you can still have your businesses, you can still have your job, but a percentage of your income. So first you want to cover your expenses, your rent, your mortgage, your food, whatever you need, cover that. And technically what's left over, right, a percentage of that should automatically be put into the market. That will ensure you're building your financial future. Because one of the things you might have noticed, if money is just sitting in our bank account, it always finds ways to leave our bank account. Some expenses come up, you see a Facebook ad that you love, you want to buy this thing. Money will find ways to just leave your account. So the fastest way you can get ahead of that is to let it leave your account before other expenses get it. You take care of yourself first, right? You put your money first, and then if you have leftovers, freely spend it. So again, you see how the numbers keep increasing as we play with these numbers. Now, the reason I want you to use that is whatever your goal is, you want to be a millionaire in 25 years. You're going to be able to put in those numbers in those calculators to see exactly when you're going to get there, right? Exactly when you're going to get there. So play with those numbers on your own time, but I want to keep moving. I want to show you the power of compounding and why starting early is the biggest important thing when it comes to investing. Investor number one, right? That person starts early, right? He stops investing after the age of 34. But now he's going to be at 787,000, in his lifetime, in his 50s, 60s. Investor number two actually puts in more money in the market, but because he started late, right? He's still going to have a beautiful return, but it's still going to be lagging the person who started early. So what am I trying to say? The biggest thing in investing that you have is your time, right? Time. The sooner you start, the better it's going to be. Now you might be wondering, but Anmol, I'm already in my 40s, 50s, 60s. I already missed the boat. No, you didn't. Because 20 years from now, you'd be wishing you started today, right? So you want to be starting wherever you are, wherever age limit you are, start today. The Dow Jones, okay, take a look at this screen. The Dow Jones was $64 in 1921. It peaked, right? Actually went higher today, but at 41,585. That's a 64,876% increase. Now, let me ask you this question. Where do you think, based on this, the markets will be in 2032, 2042, 2052, 2060? Where do you think it's going to be? The most reasonable answer is higher, right? So based on that, shouldn't we be investing in it today? But Anmol, the market's at all-time high. Yeah, it is today, but it's going to be much higher 10 years from now, from this point onwards, right? Even though it might pull back, the answer is higher. Okay, so I want to go into this. Take a look at this chart. This shows you all the returns that the stock market has given over the last year. Typically, what you're going to expect is about 10%. That's a reasonable number. Some years the markets give you 20%, 15%, some years they're down. But an average over the course of 10 plus years is going to be roughly 10%. Now, I'm going to go out on a limb and say you're not getting 10% right now in your bank account, right? You're not getting that. So if we get even 10%, inflation's at 6%, guess what? We're 4% ahead of our money, right? Our money is now working for us, okay? Now, mistake number 4, watching the news or listening to pundits, right? We all do that. We see these beautiful guys on CNBC wearing this beautiful suit, a beautiful tie, and we're like, he knows something. But not really, right? Not really. If you're listening to news or pundits, they're always going to lag you because oftentimes we see the person on screen, but we don't know his track record, right? And the track record here is this. Over the past 15 years, 92% of hedge fund managers have underperformed the market averages, meaning you'd be better off just putting your money yourself in an index fund, in an S&P 500, in a VTI, in a VOO, in a QQQ, and you're going to get better returns than 92% of so-called professionals that do this for a living, right? And that's why we don't want to be listening to people on TV or CNBC or anybody for that matter, because what I'm going to share with you, as I said, is applicable across the board, okay? Here's another thing. Active fund managers, there's an article, trail the S&P 500 for the 9th year in a row, right? 9th year in a row. So think about it. Millionaires, billionaires, they're putting in money in their hedge funds and they're actually getting less returns. So that gives us the opportunity, the average investor, to get better returns than most anybody out there by just putting it in an index fund, right? So that's why I want to talk to you about, like, okay, you should be investing in an index fund on an ongoing monthly basis. And as we touched upon earlier, your number one asset in life is time. There is nothing valuable than time in investing. Time is money. The sooner you start, the more the compounding is going to work in your favor, right? And compounding, what it really means is, let's say you start with $1,000, you get 10%. Now you have 1,100. But the next year, your 10% is going to be on that 1,100, right? And it keeps growing like that. So it's like a snowball effect. Compounding is like a snowball. Imagine a snowball rolling down the hill. As it keeps collecting snow, what happens? The snowball gets bigger and bigger and bigger and bigger and bigger. That is the power of compounding. Most people get discouraged in the first year investing. Oh, I got 10%, but I only made like this much. I'm like, yeah, but wait, what happens after 6 years, 7 years? Typically, your money would double every 6 to 7 years if you do that, right? How many of you guys would like your money to double every 6 to 7 years, and you're not really doing anything for it? You're just putting it into the market, right? So that's what we want to do. Time is money, okay? And the reason we want to do that is because of inflation. Here's the buying power of $1, right? $1, what it was worth, let's say 1975, is roughly worth 10 cents in today's money. So your buying power is actually go down. What a dollar could buy today is actually equivalent to 10 cents of today's money. So that's how the money value of the dollar has gone down, because we keep printing more money every day, right? Every day there's more money being printed, sent across the world, sent it to everybody but our own country. But I don't want to get into that. So if you have a dollar today, you're going to need at least $4.81 after many, many years to make it worthwhile. So $1 in 1975, what it could buy, you would need $4.81 to match that dollar that you had. So every day your money is just sitting in your bank account where you think it's safe. It's not really safe. It's actually losing money while you might not notice that. So that's why we want to get ahead. Buying power of $1 in 1975. You can see how the chart consistently keeps going up. And it's not going to change anytime soon, right? It's not going to change. Our Federal Reserve debt is at a record high, right? It's not going to change anytime soon. It might even accelerate. So we always want to get ahead of that money so we're not caught off guard when we're in our 50s and 60s and 70s. We're not thinking, oh, I got caught off guard. My money's not worth anything. So that's why we want to be investing. So hopefully I've convinced you here that you need to be invested in the market, right? Mistake number 5, the next one that I want to cover. Okay, this is an interesting one. Investing on emotion or gut feel. And in brackets I put which you don't have, okay? Because you don't have a gut feel. What is gut feel, right? Gut feel is basically our experience giving us an inner voice. Hey, look at this, right? But if you don't have experience, how are you going to have a gut feel? Think about it for a second. Gut feel only is reliable when you've experienced, you've seen the movie before, as I say it. You've seen the picture before, you know how it ends. Then your gut feel is basically your experience talking. But without experience, that's not a gut feel. That's just you trading on a whim, investing on a whim. And we don't want to do that. I read an article online. I'm like, that article was published 2 months ago. You're late, right? Or that article is published by, when I was a college student, I used to write articles for Yahoo Finance. Maybe it's just a guy in his dorm room writing an article. So you don't want to do that. You don't want to invest in emotion or gut feel. When it comes to investing, you want to follow a system because emotions will always let you down. You'll always sell a stock when it's going down because you feel fearful. And when it's going up, you're never going to sell it because you're greedy. It's going to go higher. But money is only made when we sell an investment. But again, that really applies when we're picking stocks, which again, if you want to learn, I can teach you that. But I want to show you investing in the stock market where you don't have to worry about getting out or timing the market. You just want to put in money every single month. So whatever your business is producing, whatever your job is producing, take a percentage, tuck it away, invest it in the market. Now you could use index funds like the S&P 500. On your brokerage account, it'll say SPY. You can put it in the QQQ, NASDAQ. You can put it in VTI, Vanguard Total Market Index Fund. And those are the vehicles that we want to use to build our wealth, right, for the long haul. We want to take care of our financial future. Okay, you don't want to be in your late 50s, 60s, your grandchildren asking you, hey, what investments do we have? And you're like, I didn't do that. You don't want to be in that position, okay? Here's why I said we should not be picking stocks. Most of you should not be picking stocks on their own. Here's an article from MarketWatch. It says, Americans are still terrible at investing. Annual study shows. So most investors, typically when they're buying, selling on their own, they're going to get about 4%. But the market's giving you 10%. So why would we work so hard picking stocks when we can just get what the market's going to give us without having to do any of the work? So that's why you want to be invested in the stock market, okay? Now, here are some notable market crashes. Again, you can read this on your own time, right? But 1907, 1929, all these market crashes we've had, the Great Depression. And people would look at all these things and say, I don't want to invest in the market. It's so risky. What are the market crashes? Well, markets will crash, right? We might crash again in the next few months, but realize it's going to be short-lived, right? And we're going to go right back up like we have since 1900s, okay? And we've gone through the Great Depression, the financial crisis, the crypto bubble. We've been through everything, but the market still made an all-time high today. So don't worry about market crashes, okay? So I want you to just kind of type in the chat, right, on if you guys worked it out, what is a percentage that you personally feel comfortable? Because I don't want this to be just another presentation that you just learned and you're like, okay, I feel great, I should be investing. And then you go home and you do the same thing over and over again. So think about it. What percentage, just type it in the chat, what percentage of your monthly income can you comfortably put in without you noticing? You don't want to notice. Just keep tucking it away, keep tucking it away, almost like that money doesn't exist. And then 10, 20 years from now, you're going to send me an email saying, oh, you were right. I invested in the market. Thank you so much. And I'm looking forward to that. All right, some people said 10%, 20%, 25, 30. That's good. That's big. I mean, I was thinking 10%. 10% super realistic. Michael says 70%, okay? I mean, hey, if you can do that, guess what's gonna happen? You're gonna get to your goals faster, right? Because those calculator that I showed you earlier, the more you put in, the faster you're gonna get to your goal, right? But I would say typically 5% is the bare minimum you should be doing. If you can do 10, even better. Even at 10%, you're gonna get to your goals. But now if you can do 15, 20, you live below your means. If you live like me in New York, we can't do 50%. Our expenses are so high, right? But I think everybody in here can do comfortably 10%, okay? All right, so that's kind of what I wanted to talk to you guys about today, is investing in the markets. Now, obviously, you know, if you want to learn trading or anything like that, that's something that I do every single day, and I can help you with all of those things. But today I wanted to kind of talk about like, okay, I know what I've shared with you today, right? I know what I've given you, but I really don't know what you've received, right? I don't know. Because you might be listening to this and say, you know what, that was great, Anmol. Yeah, I should be investing. Your brain start turning, but then the presentation goes by and then you go back to your daily life and nothing ever changes. So the thing can only change when you change, when you do something different. If you want something different from life, you have to do something different. You have to do something different. So what I want you to do is take action. Work out your numbers. What's my goal? Where do I want to be in 25 years? Let's plug it in the calculator. How much would I need to start with, right? Looking at your finances, looking at your credit card statements. Okay, what expenses can I cut down? How much can I invest into the markets? So you want to note all of that down so when you get off the call, you have a plan. You want to execute on that plan. Because the biggest roadblock is here, right? Nobody's stopping us. It's right in here. I don't know, but the election's coming up. And all those thoughts keep going. The market's always gone higher. Sure, it might go down, but it's always going to go up. So hopefully I've convinced you of that. But I also know that without the right mindset, it's not going to work, right? I work with traders around the world, investors around the world. Recently, I've been coaching hedge fund managers on their psychology because guess what? We all struggle with our mindset. We all struggle with psychology. And I don't want you to struggle. I want you to get there for sure, okay? But your mind is always going to lead you astray. It's always going to put in doubts in your mind. But I think I need to know more. I think I need to learn more. Yes, it's great to learn more because I realized investing was the biggest personal development journey that I've ever embarked on. I learned so much about myself being an investor because when you're risking millions of dollars every day, it could bring out the best in you, but it could also bring out the worst in you. You get all these fears, all these doubts coming by. When you see sometimes I see my account, I'm down like this amount, then I'm back up. It's a roller coaster. It affects your emotions, right? So the way I work with hedge fund managers is on their mindset first, because without that, nothing works, all right? You can learn the best strategies in the world. Everybody here can learn the best strategy in the world, but why is it some people make it and some don't? It's right in here. It's your mindset. Who takes action faster is the one who gets the result. I've probably spent millions of dollars hiring coaches, mentors, books, retreats, seminars, like all that I've done, and I realize not everybody has that time or the money to invest into themselves, right? So I took everything that I learned, put it down in a book, and I just want to give it to you for free. There's no charge, and it's not an ebook. I actually want you to send you the book, right? I don't have your shipping address, so just scan the QR code, right? Or go to go.anmol.net, scan it, put your shipping address on there, right? And just grab the book. We'll ship it out to you. Give it about a week or so for you to get it, but we'll send it out to you. And if you want, there's audiobooks and all those things available as well. But the reason I want you to get the book is not to get the book. I mean, you can buy it on Amazon if you want for $40, but I want to just give it to you. It's free. It will ship it to you, okay? But I want you to implement all of that. Promise me that you're not just gonna make this another book that you got and it's just sitting there, just like the 20 other books you have sitting there, Or maybe you read like 5 pages of it and you just keep moving on. Or maybe you finish the whole book and then you're like, all right, what's next? What's the next book I gotta be? That's one of the keys in my book. It's called the learning loop. How we get stuck in the learning loop, our mind convinces us that we're not ready. We need to keep learning more. We need to keep learning more. I need more information. But knowledge, right, is applied knowledge, right? Otherwise, it's just organized information. You're just collecting information. Information is not going to change your life. If it did, everybody would be doing well, right? So don't move on from one book to another book, one podcast to another podcast. And that's why every chapter at the end of the book talks about, here's the 5 things I want you to do before you can even move on to the next chapter. Because this isn't a book that you just read and say, I learned a lot. I want you to implement it. All right. So hopefully that was helpful. Grab that book. I would love to hear from you, and I would love to work with you. If you want to, get more into investing and trading, happy to chat. I'm always here as a resource for you, and hopefully you guys learned a lot. So just type it in the chat. I commit to investing in my financial future. Just type it in the chat. I want to see who's committing. Who is committing? Let's see. Michael's already committed. Great. All right. Sophia, Mary, Pamela, Brent. Beautiful. Okay, so now I'm going to screenshot this. I'm going to come after you because you just committed something to me right now. Okay, you just committed. So don't be the person who commits and don't do it. Commit first, figure the rest out later. All right, thank you, everybody. That was my time. And Mo,